and I'm joined here today by my friend and colleague, Mr. Derek Layton. He's one of our lending officers. Derek, how are you doing this morning?
I'm doing great, Trent. How are you doing?
I'm doing just fine. I'm ready to get going here.
Yes,
So
sir.
before we get started, let's do just a quick couple of housekeeping items. I think we've got everybody on mute here. Certainly, if you've got any questions, there's a chat bar, I believe, on the right side of your screen. So please put those in there, and we are going to wait to the end to address those. And we'll add a little bit of time there at the end to answer any other questions that you might have. We will be sending these slides out following this presentation, so please be on the lookout for those if you need them. Otherwise, the goal of this is going to be to provide you some information on asset growth, much like Derek and I had a video that released last week. We gave a few stats on some asset growth within our district, so we're going to talk about that a little bit more. Following that, Derek's going to give everybody an overview of some of Federal Home Loan Bank's products and services, especially those that are very relevant to the times that we're in right now. And he's going to talk about the ins and outs of those. And then to wrap things up, I'm actually going to dive in to a few specific strategies that I see being used right now, even in this highly liquid environment that we're in. Being out on the road as the account manager, I see a variety of different ways people are using our products, and so we're going to put some hard numbers to some of those so you can see what that looks like. I always like to start these webinars off with the Federal Home Loan Bank of Topeka's mission. That is to make a difference by providing reliable liquidity and funding to help you build stronger communities. And being the account manager and certainly Derek being one of our lending officers, our overall goal is to be your trusted financial partner. And even in these times where liquidity and funding potentially aren't at the forefront of your mind, we certainly have a lot of other products and services that are beneficial to you and can help you build those strong communities and better serve your customer base. And so we encourage you to reach out to myself, to the other account managers. We're out on the road all the time. We're talking to members. We're hearing strategies they're employing. We're hearing how they're handling things, especially in these interesting times. And so we've got a lot of knowledge and expertise in a variety of areas. So certainly reach out to me, reach out to those account managers, reach out to our lending staff, and we're happy to help. We're here for you during all of those. So before we dive into the actual asset growth trends, I would like to talk a little bit about the current environment we're in. We're not oblivious to the fact that PPP and stimulus funds have inflated your balance sheets, both on the asset and liability sides of things, and deposits certainly have increased. And that has led a lot of members to decreasing their reliance on wholesale funding right now. Many that I have talked to have been rolling off broker deposits as they come due and they mature, and they've been rolling off some advances. Our advance balances are certainly down slightly, not too much, but we've seen a little bit of runoff there. And so, we recognize the environment that we're in here, but I would also like to encourage you to think about it outside of the box a little bit. When we're in environments where rates are so low and deposits aren't necessarily needed, those are times when you can lock in funding for cheaper and you can prepare for the future a little bit more. So that's kind of what we're going to talk about today, is doing some of that. Total assets have increased over the last year since Q2 of 2019 by over 17%. And certainly we know that a lot of that is due to the PPP lending. And we can see that just from the second bullet point there, Q1 to Q2. So the last quarter, we saw 11% overall growth in assets. And certainly that was largely due to the PPP lending. But even when we break it down over the last year and look at individual asset classes that don't include PPP lending, we can see that there's been a lot of growth there as well. So it's not all just PPP. The economy seems to still be chugging along at a fairly decent clip, even despite the pandemic and the lock-ins and the isolation that we've been seeing. So this chart here shows that loans, which does actually include PPP, over the last year up over 15.3%. But then when we break it out into other asset classes that exclude the PPP, we can see securities up 8.7%. I mean, that is fairly significant there, especially considering the low yields that we're seeing on securities right now. My personal opinion is that some of this had to do with PPP as well. With the stimulus funds that have come in, public units have more deposits to put into institutions, and so we're seeing those institutions purchase more securities to help ensure those public unit deposits. And that's of course where, if you didn't want to put on low yielding securities, you could use letters of credit. And we're not going to talk about that much today, but certainly if that's something that's going on at your institution, please reach out to one of your account managers. They'd be happy to discuss those kind of strategies with you. But then when we look a little bit farther down the line at other actual loan categories, 1 to 4 family up over 7%, commercial real estate over 8. So still a lot of good growth there. And those two in particular, along with farm real estate, are what we're going to look at funding today, and hopefully offsetting some interest rate risk, taking advantage of this low interest rate environment, and look at some of that. But I always like to include the farm real estate. I know it's not even quite 3% growth, but when you consider how low of how low a supply of farm real estate is actually out there, 3% growth, and this is just in our district. This doesn't include anything that potentially went to competition like the farm credits. 3% growth is still pretty good from that category. And so, with a lot of those going to competition, we're actually going to look at some strategies to where you can maybe compete a little bit better in that arena. And if there are available farm real estate loans, you can get those in your door as well. So potential FHLBank uses. Of course, there's a wide variety of uses that we have. And this is just kind of some background before we dive into the products. But the contingent liquidity piece that you see there on the left-hand side, that's one that right now maybe isn't as important. Of course, we want the contingent liquidity there. We always need it there. But when you're highly liquid, contingent liquidity is probably not at the forefront of your mind. But certainly, Federal Home Loan Bank helps out with that. And then also on the bottom of the pie graph there, you've got the financing special events. So whatever you might have come up, we've certainly got products and services that can help you with those particular things. And the most important piece of this pie chart, I think, with the environment that we're in right now, is the asset liability management piece. I mean, everybody's very liquid. You've got a lot of money on your books. What are you going to do with that money? If you think that all this PPP deposits are not very sticky, that they could be running out the door pretty soon, using those for securities or using those for loans can maybe be a little bit nerve-wracking. But then what else are you going to put it in? The Fed's paying 10 basis points. That's not a whole lot. And so if you are looking to do those securities or those loans, you can still do that with a portion of those PPP funds. But that's where the Federal Home Loan Bank comes in to help offset some of the risk of those running out the door. So we can help with interest rate risk management, fund that asset growth, add spread, and provide you with a wide variety of uses with these products, and help you put those PPP funds to work without the worry of them running off and you having to potentially find higher cost of funds to fund those assets that you've got. So that's what we're going to look at a lot today, is how can you use us to manage those particular things. So the benefits of using the Federal Home Loan Bank: fast, flexible, and friendly is what we talk about all the time. Of course, Derek and our lending staff, they're very easy to work with. They make doing those transactions very simple. All of our products are pretty straightforward and easy to use. And if you haven't used them before, we've got the staff to help walk you through the process and how those work. We're certainly viewed favorably by the rating agencies. We've never heard any pushback on that side. And I think one of the most important things is the low cost of funding. Our rates are very competitive. We constantly are checking ourselves against other wholesale funding sources and ensuring that we're competitive in that area. One way that we remain competitive is the high dividends that we pay on stock that you purchase with the Federal Home Loan Bank to support those borrowings. And I'm going to talk a little bit more about that once Derek finishes up his side of things. But I think for right now, I'm going to go ahead and pass it over to him, and he's going to start walking through some of these products that are relevant in this environment before we touch on the strategies that are going to utilize those. So Derek, go ahead and take it away, man.
Awesome. Thanks a lot, Trent. And then I just kind of, want to echo what Trent said earlier. If you guys ever have any questions, please reach out to, your account managers or us on the lending desk. We are here to help you guys. So always reach out with any questions, no matter how big or small you guys have. And then, so our first product we're going to talk about today is our most popular product, and the one a lot of you are probably familiar with. That is our line of credit. A couple of details you can see here on the screen. It is a $100,000 minimum to draw on the line of credit. There is no minimum pay down. However, you can pay down whatever increment you would like. This can be drawn on or paid down daily. However, if you do draw on the line of credit, you have to wait until the next day to pay it down. You cannot pay it down the same day. And of course, the biggest use our members use our line of credit for is to meet their daily liquidity needs when they have day fluctuations. throughout the day. They can just come on and borrow on the line of credit whenever they need. And then, as Trent was mentioning too, our test your line transactions. When your auditors, come into your institutions, they are going to want to see you guys have that extra liquidity available if you guys ever did need it. And I know he mentioned earlier it's not really a big need, or probably not on your mind right now, but that still is a great way to show your auditors, how much extra liquidity you guys have available at the Federal Home Loan Bank. There we go. All right, and then so our next product we have here is our bullet advances. Some of you might be familiar with our bullet advances, but what these are is you take down this advance and then you only pay interest on the first good business day of every month. And then once your maturity date hits, you will pay final interest and principal on that date. And then there are a couple of different structures you can take down with our bullet advances. That first one there, you see our short-term bullet advance, which can be 3 to 93 days at $100,000 minimum. And then our second one is our long-term bullet advances, which can be 94 days up to 30 years. So great range of maturity dates there if you did ever need. And again, those long-term bullet advances, they do require $10,000 minimum. And then one of the great thing about these bullet advances as a product is this is again is kind of you can meet any of your general balance sheet funding with these. So for example, 5 years from now, you see you have a lot of assets rolling off the books and you don't quite have the liabilities to match up with those. You can come in and take down a 5-year bullet or whatever it may be to kind of match up with those assets to keep your balance sheets in line. And then we'll move on here. I think you might have to switch it, Trent. There we go. All right, and then sorry about that, guys. But then our next product here is probably our most customizable product we have here at Federal Home Loan Bank. That is our amortizing advances. And with these, it is right now the environment we're in, we do see a lot of demand for these long-term fixed rate loans. And that is a great thing about these amortizing advances. They can go out 1 year up to 30 years. Again, at a $10,000 minimum, you see there. And then, of course, with these amortizing advances, you do have scheduled principal payments. And then, as I mentioned earlier on the slide, these things are extremely customizable. We can set up a balloon payment. We can delay your first payment date. We essentially can match this up with the asset you have on your side. That way you keep your cash flows always on schedule, so that way they never get out of whack or anything like that. Yeah. And then so the next advance we have here, or next product we have here, would be our callable advances, which these are essentially a great way to hedge against your prepayment risk if you do have your customers that do want to prepay your loans. And then on the next slide here, we'll talk about here in a second, we'll show you how cheap our callable advances are right now. But again, these callable advances, they can be set up kind of to whatever you're needing on your side. You can either take down the bullet advance or an amortizing advance. And then again, as you can see here on this slide, after your first call date, you still get semi-annual calls after your lockout period until the maturity date. And then on this next slide here, we'll see all of the pricing on these advances here. And these are as of 8/13, I believe. And of course, like all of our other advances, they do change, but still the environment we're in right now, the cost of the call on all these callable advances are extremely cheap. And then as you can see here, the first one, our 7-year, 3-year is what we call that. So this is just telling you our normal 7-year advance was at 1.08%. And then we calculated the cost of the call. So your option to get out of the advance if you ever did want to prepay it. Your first call date would be in 3 years, and that would cost you 10 basis points. And then your all-in rate on that call option end up at 1.18 for 7-year money. So still an extremely low rate. and you have a lot of flexibility to get out of that if your customer ever did want to prepay their advance. And then next, we're probably going to talk about probably our most exotic product we have right now, which is our forward settling advances. And there's a couple of features on this advance. You get to lock in to today's extremely low rates. That would and then these again can be our bullet or amortizing structures. Any advance over 2.5 million can go out to 30 years. And then with our bullet advances, anything under 2.5 million, anything can go out to 10 years with a minimum of 100,000. And then on this next slide, we'll talk about some of the benefits we have about our forward selling advances. And as you can see here, and then again, as Trent mentioned, earlier in these slides, there's not really a whole lot of need right now if you're institutions to have this extra liquidity. The one great benefit about these forward selling advances is you can delay your funding up to 2 years when rates start to rise up again, as eventually they all probably will, or we're assuming they will, so you can lock in today's low rates for future funding needs. And again, these can be extremely customizable because we can set them up like our amortizing advances to meet whatever needs you have on your end. And then finally, the last great benefit here is to mitigate risk by securing these known funding costs at these extremely low rates for future loan production or any deposit runoffs that your institution may have.
Yeah, definitely. Thank you, Derek. I'm going to go ahead and discuss some capital stock with him here in a second. But before I do, I just want to make a couple comments on those slides that Derek showed you. Two of the most important things that stand out to me there. One is the cost of those call options on those callable advances. I mean, 10 basis points is very cheap. And for the flexibility that it provides you to avoid any potential prepayment risk that you might have, I think it's a great deal right now. So something to certainly look into. And the second one is those forward settling advances. I mean, we are at a time now where rates are at potentially historic lows. I mean, they're very low right now. And if you've got any maturities coming up on longer term funds that you've got on your books or within the next 2 years, or you've got potentially some loans in the pipeline that are going to fund at some time, right now might be a great time to lock in some of those low rates to be able to have those funds down the line. And one of the examples that we're going to look at here shortly actually takes into consideration some of that and some of the forward settling advances. So I just wanted to make those couple of comments before we move on. But with that, let's go ahead and look at capital stock and discuss how that affects your overall rates that you're getting when evaluating wholesale funding sources that you could potentially be looking at should you need that. Capital stock, of course, we are a cooperative. You own us, and so as part of that, you have this Class A stock, this membership stock that we call it, and that's 0.1% of your total assets, not to exceed $500,000. And we currently pay a 0.5 basis point dividend on that. And so we try to keep our dividend rates on Class A, especially competitive in the marketplace with alternative investments that you could get. So when you're only getting about 10 basis points, if you park money at the Fed, 50 basis points doesn't sound so bad in that scenario. So certainly a good benefit there, even just owning membership stock. And then our Class B, our activity-based stock. When you start using the Federal Home Loan Bank, you start accumulating these shares at 4.5% of the principal balance of any borrowings that you were to have. And right now, currently, the dividend on our Class B stock is actually 5.5%. So it's very high. So the benefits of using Federal Home Loan Bank are very good. Accumulating this stock is a great benefit. And that 5.5% dividend with the 4.5% activity requirement, we typically say it takes about 20 basis points off of the quoted rates that we give you just from the dividend income that you receive. So certainly all those inexpensive rates that Derek was showing you, you can take a little bit more off of that when you're receiving this dividend income. So certainly something to consider, and we'll kind of talk about that a little more when I show you some examples and how that'll play in. But these dividends are paid quarterly. We do have some exchanges and some sweeps. And if you have any questions about the real nitty gritty details of how the stock works, please reach out to your account manager. They're always happy to have that conversation with you. But before we move on, let's take a look at the specific impact. So here's an example I put together. At the top of the screen there, you can see it says assumes assets of 450 million. That's about the average asset size of our member institutions, and so that's what I went ahead and used. And then on the right-hand side, you can see what our dividends are paying right now, and then the 4.5% capital stock requirement. The total funding to utilize Class B stock box in the middle. So that would be 4.5% of your total asset size, so $10 million there. And what I call that is the Class A hurdle. Once you get over that, so when you borrow, we have you use your Class A stock that you have on the books first to support those borrowings. But once you get over that Class A hurdle, that $10 million, you start accumulating Class B shares, and that's when you start getting paid the higher dividends. And so we always like to kind of point that out, so that way you know kind of where you're at on the curve there. But if we start looking at the curve, we can see that for the first $10 million, there's only about a 2 basis point impact because you're only getting paid 50 basis points dividend on that first $10 million because you're supporting it all with Class A shares. But once you start getting out past that, you can see that it substantially starts to increase what the impact of that dividend is. And we offer this chart to everyone. So if you want to see specifically where those thresholds are for your institution, please reach out to myself, to Derek, to your account manager, and we can run something like this for you to give you an exact feeling of where you're at along that curve. So now we're going to dive into strategies. And this is one of my favorite parts because all of these I have worked with members on, and they have worked, and I've seen them used. And so the place where I'd like to start out is with the FSA. As I mentioned before, I think there's great opportunity there for this. And with the PPP funds that are on your books right now, we've got some people that are under the impression that these are going to be temporary. We've got some that think they might last a little longer than others, but I would have to think that at some point these funds are going to roll off. Even if it is 2 years, which I think is the maturity on some of the PPP funds, I would think that they're going to roll out the door at some point. And so preparing for deposit outflows, FSAs can do that. If you've got some sort of idea of when you think those PPP funds are going to roll off, lock in some low rate funding now before rates potentially rise 6 months to 2 years from now, and you're covered there. You've got yourself covered. And with all these strategies that I suggest coming up, I don't ever say go all in on anything. I mean, I'm definitely more of a hedger. So if you think that you've got $5 million of PPP deposits on your books and you're not sure when it's going to roll out, but you think that a decent portion of it will in the next 6 months, then fund 25%, 50% of what you think could roll out, and that just kind of hedges all your bets. It allows you to do that, and I'm certainly an advocate for that side of things. But you can replace alternative funding maturities with these. If you've got broker deposits on your books, when those are maturing. Do you need to replace them? Are they tied to a loan that's going to renew? If you need to replace those, it might be good to lock in an FSA right now and take advantage of the low rate environment. Certainly preparing for loan growth, as I mentioned earlier. If you've got a bunch of loans in the pipeline that are going to fund 3 months from now, and you want to not have to worry about what the cost is going to be in 3 months, and you want to go ahead and get it locked in now, forward settling advance is great for that. So let's take a look at the actual numbers, put a few numbers with the strategy. These rates were as of last week, so we would need to refresh these a little bit, but honestly, the rate environment hasn't changed a whole lot since then, so we're probably pretty darn close. So with this first example here, what I did is I took an old structure. So the old structure was taken down when this advance was taken down, or when this funding was taken down, it had 5 years to maturity. Now at this point, it's got 2-year term to maturity. So it's got 2 years left. And that was at an old rate of 250. So what I wanted to assume and what I wanted to show in this strategy is if you wanted another 5-year maturity advance, or if you wanted 5-year money once this particular funding matured in 2 years, what would that look like? And so the FSA structure 2 years forward, so this wouldn't settle, you wouldn't get this funding until the other old one matured. And then when that happened, you would then have 5 years to maturity after that. And right now, a rate on that is at 1.09. So you would get 5-year money 2 years from now at locked in 1.09, replacing that 250 that you had before. And so you can see the significant difference in where rates were at. And with the old rates that I used here, I tried to go back and look and be somewhat accurate on where those stood at the time, so that way we could get at least somewhat of an accurate comparison and not just made up rates. So this is pretty close to what kind of changes you could see. 3 or 1 year, 2 year, 6 month, same kind of thing. That 2 year, 6 month, I mean, you can get 2 year money at 58 basis points 6 months from now. 6 months from now, we don't know where things are going to go. We'll have made it through a lot of uncertainty through the end of the year, and rates could easily be rising at that point. And so locking in a little bit of money now at these rates that you know aren't going to hurt you down the line, not a bad strategy, I think, in my opinion. The next example that we're going to look at is match funding. So this is one-for-one match funding an asset, match funding a pool of assets, and really taking interest rate risk out of the equation, locking in spreads. I see these used for, like I said, pool of mortgages. If you've got a certain duration in that mortgage portfolio where you think you have a lot of exposure, say 7 years, 8 years, you could match fund some of those cash flows with amortizing advances, and take some of the interest rate risk out of the equation. Certainly, security strategies we see match funding used on especially mortgage-backed portfolios and munis. So if you are interested in those kind of investments, then potentially match funding could work for you. And then just specific loans, if you've got especially a large borrower that's coming in and you want to match up those cash flows and lock in a spread, this is the kind of strategy that would work for you. And there, as we showed earlier, assets are still increasing, loan portfolios are still increasing, and so if even in this uncertain time, you could still have a use for match funding. This right here is an example of what that could potentially look like. What I want to focus on the most is at the bottom of the chart there, the table that's there. So on the left-hand side, you've got the asset. So we're looking at a $1 million asset that has a 7-year maturity, and we're going to fully amortize it, so the 7 years. And so what this particular strategy is that I put together is funding a pool of mortgages in a mortgage portfolio. I'm saying that in this particular instance, the institution had a hole in their balance sheet at the 7-year point. They had a lot of duration in their portfolio that was roughly 7 years, and they want to offset a little bit of that with Federal Home Loan Bank advances and try to match those cash flows up as best they can. And so that's the asset. On the advance side, we're going to match it 1-for-1. 1-for-1 means we're doing $1 million fully amortizing 7 years, and the rate on that particular advance is 99 basis points. And so you've got an asset yielding you 5, which I think would probably be fairly close. I know we've had a lot of refis, so you may be seeing something a little bit lower than that when you pool all your mortgages together, but I also kind of assume that you've kept some higher rate ones on there. So roughly 5, and then at a rate of just under 100 basis points is going to get you on the far right and a spread for the asset life and the advanced life of 395 basis points, which great spread. And this has removed all interest rate risk from the equation. You may still have a little bit of prepayment risk if something was to refi, but right now we're kind of at the bottom of the interest rate cycle. At least I think we don't have a whole lot of room to continue to go down on some of those longer term fixed rate loans. And so that's where getting these match funding strategies and not worrying about where interest rate goes after this, locking in those spreads, this is a great strategy for it. And the other thing that you can take into consideration here too is that dividend that we talked about. If you're using Class B stock and getting about 15 to 20 basis points benefit, add that on top of the spread that you're making there. You're just adding additional income from the dividends you'd be receiving. So the second to last strategy I'm going to talk about, and these are all strategies that I've talked with members about in the last 6 months, and so that's why I wanted to bring them all up. This one is what I call a ladder of bullet funding strategy, and typically it is used for general balance sheet funding, and it's very similar to an amortizing advance, just with yearly principal payments. But I like this strategy because it takes into account some of the lower rates on the short end of the curve, mixed with potentially a little bit higher rates on the longer end of the curve, and get you a decent average overall cost. And so what we're looking at here would be 10 years worth of funding, doing a total of $5 million, locking in $500,000 each year for 10 years at those different rates. So what you have posted in the red over on the left-hand side is exactly where each one of those bullet rates is at. And so you've got a 142 on a 10-year and 49 basis points on a 1 year. And so that shows that the weighted average advance rate for the first year only, so you're taking into consideration all those funding costs on that first year, First year, we would be paying 94 basis points essentially for $5 million plus the dividend that you could receive. On the right-hand side, it shows the amortization portion of a ladder of bullet strategy and how 500,000 of that rolls off each year. And when you take that into consideration, you get a weighted average advance rate over the life of the advance of about 1.1, 1.09. And so still pretty cheap 10-year funding when you look at it that way. But how I typically see people use this strategy is, like I said, general balance sheet funding. But what that means to me is as one of these rolls off, they add another one on. So when the first year maturity comes up, they'll throw on a 10-year maturity. And this allows you to kind of dollar cost average as rates move around. If rates continue to drop a little bit, you might be able to add some cheaper funding to it. If rates rise, you've still got all this cheaper funding you already locked in, but now you're averaging it with a little bit higher funding that potentially has come now. So that's, I think, why I like this strategy. It allows you to just roll with the interest rate environments and take advantage of any situation that we're in. All right. Last but certainly not least, we are going to talk about a blended funding strategy. I really like the FSA one right now, but blended funding is probably my favorite strategy, no matter what interest rate environment we're in. But particularly in a downward environment, it's very good. This is the one that really allows you to compete with those other institutions that are out there vying for your customers' loan business. The farm credits, the other mortgage lenders, anybody else that's looking for commercial real estate projects. This can help you provide them better rates and still be able to lock in funds for them, because on a lot of these different things, they want longer term loans. And so, funding it all short sometimes can be a little bit risky. And if you're able to fund it a little bit longer, that tends to help. It helps mitigate interest rate risk. Of course, doesn't take it all out of the equation, because in this strategy, we're going to use some Federal Home Loan Bank money, and we're also going to use your internal cost of funds to allow you to lower effective rates, and provide better rates to your customers. So it doesn't take away all the interest rate risk, but certainly mitigates a good portion of it, and then certainly offers flexibility. It allows you to be lenient on prepayments with your customers. Of course, we have some prepayment language, as Derek mentioned, in the majority of our contracts for our advances. But if you're funding, 40, 50% of it internally with your cost of funds, and it's overnight money, you've certainly got some cushion to absorb some of those prepayments should your customers start to do that. And that's one of the big reasons I like this strategy, because most customers aren't looking necessarily for the prepayment language that's in there, or your competition doesn't put it in there. And so you need to be able to compete with that effectively. So let's take a quick look at an example that I put together. This is one that I actually talked about maybe 3 or 4 weeks ago with a member, and we were competing with Farm Credit on this one. We were trying to help them get a spread that they liked locked in using some of their internal cost of funds, and then they were able to get the deal done. So this strategy certainly works. So on the left-hand side there, we can see what the asset is. Their customer wants to borrow $250,000. They want to put it on a 10-year maturity with a balloon, with a 20-year balloon. So we're looking at an amortization period of 20 years with a 10-year maturity. The yield that they were offered elsewhere, the rate that the customer was offered elsewhere was 4%. And so our member just wanted to be able to offer them 4% or less. So our member wanted to make 4% or less, or 4% or more. And so the advance in this case, we were going to do a 60-40 split. We were going to do 150, and then the member was going to fund 100,000 of it internally. And so when we took a look at that, they were going to fund $100,000 internally, and we'll look at their cost of funds here in a second. So when we look at that, they were going to do exactly the same structure that they were going to offer their customer. So 10-year maturity, 20-year AM schedule, and the rate on our side on that type of an advance was a 147. And so just with the 4% and the 147, we had a decent spread there. But then you factor in the cost of funds that they're using internally for the other 100,000 that they were funding, which at the time was below 70%. I think maybe they were sitting at like 50 or 55 basis points on their internal deposit cost of funds. But I always like to overestimate that a little bit, because likely through the 10 years of this funding period, you're going to see cost of funds rise a little bit. And so I like to be a little bit conservative from that front. But when we took 70 basis points, them funding 100,000, 147, us giving them 150 to fund the entire asset, we got a life of 84. They were looking for somewhere between 225 and 250, and so we were able to actually exceed that, not even including the income they were going to receive from the dividends. So they were able to easily compete with Farm Credit in this particular situation, and so that's why I like these. And then they still had that $100,000 cushion that if their customer wanted to prepay a little bit, they could pull from that and be able to absorb it and move on down the line and not penalize their customer for that. So definitely a great strategy. And certainly if you want to talk about any of these, we are happy to. This particular tool that I'm showing here that I've used in a couple of the examples, highly customizable. We can do any scenario that you want. If you've got something that you want to look at, reach out to us. We can run it and we can show you what kind of spread you could expect. And we can kind of go from there and help you out with maybe other strategies that could work for what you're looking at. But, you know, the goal of this was to give you an overview of some products that can be used in this environment. You know, we're not oblivious to the fact that you're very liquid, but I still think that even in this environment, advances and are important part that you should be considering. Locking in some of these low rates, taking advantage of that while you can. I know that if rates do happen to go up a year and a half from now and you locked in one of those FSAs and now it's 100 basis points more expensive for that funding, you're going to be super happy about that. And I think that we don't have a whole lot of room to go down. So even if you lock it in and we're at the same spot, you don't have funding that's too overly expensive a year and a half from now. So certainly a time to do that. And we're your trusted financial and liquidity partner. And so if you've got any of those questions on how you could potentially manage that or what we've got available for certain situations that you have, please reach out to myself. Please reach out to Derek. Please reach out to your regional account manager. And on the next slide here, I've got everybody's contact information. So certainly if you need that, it'll be there, but we've got a lot of other things that we offer. We've got tools for a variety of different scenarios. That letter of credit strategy that I mentioned earlier, got a great tool to analyze that. So if you're looking for something there, let us know. But overall, we just want to be here for you, especially in these trying times, and help in any way we can. And so with that, here is the contact information for all of the account managers out there, and then as well as Derek, who's with me today. And Derek, thank you for walking everybody through those products. That was some great information and helping me out with that today.
For sure, Trent. And then one thing I do just want to say is, the best part, working here is talking to you guys. So please, no matter what question, how big or small, always reach out to us. Just come talk to us and see if we can work something out for you guys.
Yeah, I've certainly mimicked that. And with that, I don't know if we have any questions. Jesse, I think that you might have been monitoring that queue for us. If you see anything in the chat box, any questions in there, let us know. But please put them in there if you've got them. We'd be happy to answer them. Or if you would prefer to reach out and contact one of us, we're happy to do that as well. But we're going to stay on here for about 5 more minutes just to make sure that we answer any questions that you might have. And otherwise, everybody, enjoy the rest of your day. Enjoy the rest of your week. If you want to see us again tomorrow just for fun, I think we'll be on at, I think it's 2 o'clock, right, Derek?
Yes, sir. 2 o'clock.
We'll be on at 2. So if you just want to see our faces again, we'll be there. But otherwise, please enjoy the rest of your day. And
hey, Trent, I just wanted to, Trent, this is Jesse. And can you just let everybody know again about the slides being sent out?
Yes, absolutely. We will be sending these slides out following this webinar. So, keep an eye out for those. Certainly, if you don't see them here in the next few days, let us know, and we can get them sent to you directly. But those will be sent out. Thank you, Jesse.
Okay.